The dazzling lights of the Monaco Grand Prix flash across the visor of a Formula One driver as he navigates hairpin turns at 190 miles per hour. The camera pans to a yacht in the harbor where a tech billionaire sips champagne, watching the race through diamond-encrusted binoculars. Cut to a Wall Street trading floor, then to a penthouse overlooking Central Park. What do these scenes have in common? These are glimpses into the lives of people who have mastered what economists call tax efficiency. Individuals who earn millions yet sometimes pay lower effective tax rates than their housekeepers. But what if I told you that their sophisticated strategies are merely elaborate versions of fundamental physical principles that govern our universe? What if avoiding taxation legally was not just a matter of clever accounting but actually followed the same scientific principles that dictate how stars form, how quantum particles behave, and how life itself evolved on Earth? The question sounds absurd at first. How could the laws of thermodynamics or evolutionary biology possibly connect to something as human-made as taxation? Yet, as we peel back the layers of this seemingly outlandish proposition, we will discover something remarkable. The strategies used to minimize tax exposure mirror natural systems' tendency toward efficiency, following what physicists call the principle of least action. To understand this connection, we need to start not with tax code or financial statements, but with something far more fundamental: the physical nature of information itself. In the summer of 1961, physicist Rolf Landauer was working at IBM's research laboratory when he made a discovery that would eventually transform our understanding of information theory. Landauer proved that erasing information, destroying data, always produces heat. This became known as Landauer's principle. Information is physical, and manipulating it requires energy. Fast forward to 2023. Physicist Dr. Harold Quinton stands before his colleagues at the International Conference on Quantum Economics in Zurich. His presentation is provocatively titled, "Tax as Information Entropy: Why Natural Systems and Human Wealth Follow Similar Efficiency Curves." The room is skeptical but attentive. Every financial transaction creates information, Dr. Quinton explains, pointing to his equations. And every bit of information that enters a system like taxation must be processed, requiring energy. Natural systems, from water flowing downhill to electrons finding the path of least resistance, all follow optimization patterns to minimize energy expenditure. What we're seeing in sophisticated tax planning is not just accounting. It's a manifestation of the same fundamental principle. The audience shifts uncomfortably. Is he suggesting tax avoidance is somehow natural? Dr. Quinton anticipates their concern. "I am not making a moral argument," he clarifies. "I am pointing out a pattern. Just as water does not flow uphill without external force, capital does not voluntarily subject itself to friction. Taxation being a form of financial friction, without an external mechanism compelling it to do so. This revelation forces us to ask, is there something deeper happening in the financial world than merely wealthy people trying to keep more of their money? Could tax efficiency be an emergent property of complex systems rather than just human greed? And if natural laws govern these patterns, does that change how we should think about addressing inequality? To answer these questions, we need to embark on a journey that will take us from quantum physics to evolutionary game theory, from the mathematics of flow dynamics to the thermodynamics of wealth distribution. And ultimately, we will confront a provocative possibility: that the same principles guiding rivers, atoms, and ecosystems might also explain why capital seems to inexorably find the path of least taxation. Dr. Quinton was not the first to notice these patterns. In the early 1970s, economist Nicholas Georgescu-Roegen published The Entropy Law and the Economic Process, arguing that economic systems are subject to the same thermodynamic principles as physical systems. His work was largely ignored at the time, considered too abstract for practical application. But 5 decades later, with massive computing power and big data analytics, researchers began noticing unmistakable patterns in global capital flows that resembled physical systems seeking equilibrium. Just as heat flows from hot to cold regions until temperatures equalize, capital appeared to flow from high-tax to low-tax jurisdictions until an equilibrium was reached. Not zero taxation, but an optimized balance point representing minimum friction for maximum return. This is where our story truly begins, at the intersection of physics, information theory, and global finance. And to understand it fully, We need to follow the unlikely collaboration between Dr. Harold Quinton, the theoretical physicist, and Catherine Marshall, a forensic accountant turned data scientist who had spent 15 years tracking tax avoidance for the Treasury Department before becoming disillusioned with the futility of her work. It was like trying to catch water with a net, Marshall would later write in her memoir. Every time we closed one loophole, 5 more would appear elsewhere. The system wasn't broken. It was operating exactly according to fundamental principles we hadn't recognized yet. Marshall met Quinton at a 2019 interdisciplinary conference at MIT. She had just presented her work on pattern recognition in offshore financial flows, and he approached her afterward, excitement visible in his eyes. "Your flow diagrams," he said, pointing to her slides still displayed on the screen. "They're identical to Feynman diagrams for quantum interactions. Have you noticed that?" Marshall hadn't. Why would she? Quantum physics wasn't her field. But that conversation sparked a 3-year research project that would eventually produce the most comprehensive mathematical model of tax efficiency dynamics ever created. A model that borrowed as much from fluid dynamics and quantum field theory as from economics and law. Their collaboration began with a simple observation. Financial systems, like physical systems, tend toward states of minimum energy expenditure. In physics, this is known as the principle of least action. Nature takes the path requiring the least energy. In economics, particularly tax planning, this manifests as capital finding the path of least taxation. The mathematics are uncannily similar, Quinton explained during a lecture at Stanford in 2021. If you replace energy values with tax rates and particle positions with jurisdictional locations, the equations practically solve themselves. But Marshall and Quinton weren't just interested in abstract similarities. They wanted to understand why these patterns emerged and what they meant for society. Their research led them to a startling hypothesis. Tax avoidance strategies might not just resemble natural optimization processes, they might actually be governed by the same underlying mathematics. To test this hypothesis, they needed data, vast amounts of it. Marshall leveraged her Treasury connections to obtain anonymized tax data spanning decades, while Quinton developed algorithms to detect pattern similarities between this financial data and known physical systems. What they found stunned them both. The correlation was 0.97, Marshall recounted in an interview. That's virtually identical. The way water flows through a complex river delta and the way capital flows through the global financial system, the mathematical structures are the same. Both are finding pathways of minimum resistance. But correlation is not causation, as any scientist knows. To prove their theory, they needed to demonstrate predictive power. If tax efficiency truly followed the same principles as natural systems, then they should be able to predict how capital would respond to new tax regulations before those regulations were even implemented. In late 2021, they got their chance. The European Union announced plans for a new financial transaction tax. Before the details were finalized, Quinton and Marshall ran their model, predicting exactly how capital would reorganize in response. 6 months after implementation, the actual capital flows matched their prediction with 94% accuracy. The implications were profound. If tax efficiency follows natural laws rather than just human ingenuity, then traditional approaches to tax enforcement might be fundamentally misguided, like trying to legislate against gravity. But this realization opened up an even more provocative question. If natural systems can teach us about tax efficiency, could the ultimate tax-efficient strategy be hiding in plain sight in the way nature itself operates? That question would lead Marshall and Quinton to their most controversial discovery yet. One that would challenge our very understanding of what taxation is and how it functions in both natural and human systems. The journey to this discovery began in an unlikely place: the study of slime molds. These remarkable organisms, despite lacking a brain or central nervous system, can solve complex optimization problems with astonishing efficiency. Place food sources in a pattern mimicking major cities, and the slime mold will create networks between them that closely resemble optimal highway systems, all by following simple rules of energy efficiency. What if, Quinton proposed during one of their late-night research sessions, we've been thinking about tax efficiency all wrong? What if it's not about finding loopholes in human-made laws, but about understanding the fundamental patterns that all efficient systems follow? This question led them to re-examine nature's most efficient systems, from photosynthesis to neural networks to ant colonies, looking for common principles that might apply to financial optimization. And in the process, they stumbled upon something that would change everything. The breakthrough came when they analyzed how certain bacteria form colonies. Individual bacteria follow simple rules: move toward nutrients, away from toxins, and maintain optimal proximity to other bacteria. From these simple rules emerges complex, highly efficient colony structures that maximize resource acquisition while minimizing energy expenditure. The bacteria aren't calculating anything, Marshall observed. They're just following basic principles of efficiency. And yet, the emergent behavior is sophisticated optimization. This led to their central insight. Perhaps the most efficient tax strategies weren't about complex financial engineering at all, but about structuring one's economic activity according to fundamental principles of natural efficiency. If bacteria could optimize without calculation, perhaps humans were overcomplicating the problem. To test this theory, they developed a simplified economic model based on the principles they observed in natural systems. Instead of focusing on exploiting specific tax code provisions, their model emphasized structural efficiency, optimizing the form of economic activity rather than manipulating its reporting. Their findings were revolutionary. The most efficient approach wasn't about offshoring assets or creating complex ownership structures, strategies that required constant adaptation as laws changed. Instead, it was about adopting an economic form that was inherently efficient under any reasonable tax system. Just as water naturally forms a spherical droplet in zero gravity because that shape minimizes surface tension, there appears to be an optimal form for economic activity that minimizes tax friction regardless of specific regulations. Quinton explained in their landmark paper published in the Journal of Economic Physics in early 2023. But what was this optimal form? The answer lay in another natural phenomenon: symbiosis. In nature, symbiotic relationships create mutual benefit with minimal waste. Consider lichens, composite organisms formed from algae or cyanobacteria living in symbiosis with fungi. The fungus provides structure and gathers minerals. The algae or cyanobacteria provide energy through photosynthesis. This arrangement is so efficient that lichens can survive in environments where neither organism could thrive alone. The most efficient tax structure, Marshall concluded, mirrors this symbiotic principle. It's not about avoiding taxation. It's about creating economic arrangements where taxation becomes naturally minimal because the structure itself produces social value that tax systems are designed to incentivize. This realization was the foundation of what they would call their Symbiotic Efficiency Theory. The idea that the most effective way to minimize tax burden isn't to fight the system but to align with its fundamental purpose. Just as symbiotic organisms don't waste energy fighting their environment but adapt to work with it, truly efficient economic structures don't waste resources fighting tax systems but are designed to work with their underlying purposes. To understand how this works in practice, we need to examine what taxation fundamentally is. At its core, taxation is a mechanism for addressing externalities and providing public goods, things like infrastructure, education, healthcare, and environmental protection that benefit society but that market mechanisms alone might underprovide. The conventional approach to tax efficiency focuses on exploiting gaps in this system, finding ways to benefit from public goods without contributing proportionally to their cost. But Marshall and Quinton's research suggested this approach was inherently unstable, requiring constant adaptation as regulations evolve to close loopholes. The symbiotic approach, by contrast, internalized the externalities directly. Rather than trying to benefit from public goods without paying for them, it created structures that delivered those public goods as a direct byproduct of economic activity. This naturally reduced tax liability not through avoidance but through alignment with tax systems' fundamental purposes. Consider a traditional corporation, Marshall explained during a TED Talk that went viral in mid-2023. It externalizes many costs: pollution, infrastructure strain, healthcare burdens on employees, which society then taxes it to address. The company then employs expensive strategies to minimize those taxes, and governments respond with more complex regulations. It's an inefficient arms race. But what if, she continued, the corporation structured itself to internalize those costs from the beginning? What if its operational model actively reduced pollution, invested in local infrastructure, provided comprehensive employee well-being, and regenerated natural resources. The need for taxation would naturally decrease because the externalities being taxed would no longer exist. This wasn't just theoretical. Marshall and Quinton analyzed thousands of companies across multiple jurisdictions and found a striking pattern. Organizations structured around these symbiotic principles consistently paid lower effective tax rates, not through aggressive avoidance strategies, but because various tax incentives, credits, and deductions naturally applied to their operations. The implications were profound. If correct, their theory suggested that the ultimate tax efficiency didn't come from offshore accounts or clever accounting. It came from fundamentally reimagining economic activity as a regenerative force rather than an extractive one. This concept may sound utopian, but the data supported it. Companies with the lowest effective tax rates over long periods weren't those with the most aggressive tax departments. They were organizations whose core business models aligned with societal needs in ways that tax systems were designed to reward. Nature doesn't waste energy fighting fundamental forces, Quinton noted in their research. It adapts to work with them. The most efficient natural systems are those that create positive feedback loops with their environments. The same principle applies to economic systems within tax environments. But how does this abstract theory translate into practical application? What does a symbiotic economic structure actually look like? And most importantly, how does it create tax efficiency without relying on traditional avoidance mechanisms? To answer these questions, Marshall and Quinton moved from theory to application. They partnered with economists, lawyers, and business strategists to develop concrete models of symbiotic economic structures across different industries and scales, from individual professionals to multinational corporations. What emerged was not a one-size-fits-all solution, but a set of principles that could be adapted to different contexts. These principles centered around what they called the 4 pillars of symbiotic efficiency. 1. Value integration, structuring economic activity to integrate commercial and social value creation rather than treating them as separate or opposed. 2. Regenerative design, creating processes that regenerate resources rather than merely consuming them less quickly. 3. Distributed ownership, implementing ownership models that align the interests of all stakeholders rather than prioritizing absentee shareholders. 4. Transparent complexity, embracing appropriate complexity in organizational structure while maintaining complete transparency, rather than using complexity to obscure. Organizations built on these pillars naturally qualified for numerous tax incentives without having to artificially engineer their activities to fit tax criteria. Moreover, they tended to generate types of value that most tax systems explicitly leave untaxed or tax at lower rates. Think about it from first principles, Marshall suggested during a guest lecture at Harvard Business School. Tax systems are designed to encourage certain activities and discourage others. If you structure your economic activity around the very things tax systems are trying to encourage, you'll naturally minimize your tax burden. This wasn't about exploiting loopholes, it was about understanding the underlying purpose of tax systems and aligning with that purpose. The approach worked across jurisdictions precisely because, despite differences in specific provisions, most tax systems share common fundamental aims: encouraging productive investment, innovation, environmental stewardship, and community development, while discouraging speculation, pollution, resource depletion, and social harm. But the most fascinating aspect of their theory was how it reconnected to the natural systems that inspired it. Just as bacteria forming efficient colonies aren't trying to optimize, they're simply following fundamental principles that naturally lead to optimization. Symbiotic economic structures weren't trying to minimize taxes. Tax efficiency emerged naturally from their alignment with the deeper purposes that tax systems were designed to serve. This perspective shift had powerful implications. Rather than viewing taxation as an external force to be minimized like friction or drag, it suggested viewing taxation as useful information about what society values. High tax rates on certain activities signal that society wants less of those activities. Tax incentives signal that society wants more of others. The most efficient response isn't to fight this signaling system but to adapt to it. As their research gained attention, Marshall and Quinton found themselves thrust into policy debates about wealth inequality and tax justice. Critics argued they were providing a sophisticated justification for tax avoidance. Supporters countered that they were showing a path to align profit motives with social good. The truth was more nuanced. Their work didn't justify traditional tax avoidance. In fact, it suggested such approaches were inherently inefficient in the long run. But it also challenged conventional approaches to tax policy that assumed an inherently adversarial relationship between taxpayers and tax authorities. Natural systems don't fight fundamental forces like gravity or thermodynamics, Quinton noted during a congressional testimony. They adapt to work with these forces in ways that minimize wasted energy. Similarly, truly efficient economic systems don't waste resources fighting tax systems. They adapt to work with the underlying purposes those systems serve. This perspective offered something rare in tax debates: a potential alignment of interests. If the most efficient approach to taxation was symbiotic rather than adversarial, then both taxpayers and tax authorities could potentially benefit from facilitating such structures rather than engaging in an endless cat-and-mouse game of avoidance and enforcement. But theory is one thing. Practical application is another. To demonstrate their ideas, Marshall and Quinton decided to put them to the test. They worked with a mid-sized manufacturing company to redesign its structure according to symbiotic principles. The company had been paying an effective tax rate of 22% despite spending millions on tax planning services each year. The transformation wasn't simple. It involved rethinking everything from energy sources to supply chains, from employee compensation to community relationships. The company transitioned to renewable energy, implemented circular manufacturing processes, established an employee ownership program, and integrated its operations with the needs of its local community. The results were striking. Within 3 years, the company's effective tax rate dropped to 9%, not through traditional avoidance strategies, but because various tax credits, deductions, and incentives naturally applied to its new operations. More importantly, its overall profitability increased by 34%, driven by improved employee retention, reduced waste, lower energy costs, and stronger community support. This case study caught the attention of financial media, with headlines like "The New Tax Efficiency," "Why This Company Pays Less Tax by Doing More Good," appearing in major business publications. It sparked a wave of interest from other companies looking to replicate the results. But Marshall and Quinton were careful not to oversimplify. "This isn't a magic formula," Marshall cautioned in interviews. "It's a fundamental rethinking of what economic activity is for and how it relates to society. The tax benefits emerge from that alignment, not from trying to game the system." As their work gained recognition, they began to notice something interesting. Their theory was particularly relevant to emerging sectors like renewable energy, regenerative agriculture, and circular manufacturing. These industries, structured around principles of regeneration rather than extraction, naturally qualified for numerous tax incentives across jurisdictions. This observation led to their next major insight. Perhaps the future of tax efficiency wasn't about avoiding taxes within the current economic paradigm, but about positioning for the emerging economic paradigm where tax systems increasingly rewarded regenerative rather than extractive activities. "We're seeing a global shift in tax policy," Quinton noted in a 2023 paper. "Across jurisdictions, activities that regenerate natural and social capital are being increasingly incentivized, while those that deplete it face growing taxation. This isn't a temporary trend. It's a fundamental realignment of tax systems with biophysical and social realities." This shift created an opportunity for what Marshall and Quinton called anticipatory tax efficiency, structuring economic activity to align with the direction tax systems were evolving rather than their current specific provisions. This approach provided more stable long-term tax efficiency than constantly adapting to changing regulations. But as their theory gained traction, they encountered a significant challenge: quantifying the value of activities that traditional accounting systems didn't capture. How could companies demonstrate the value of rehabilitated ecosystems, improved community well-being, or enhanced social cohesion? Without reliable metrics for these outcomes, it was difficult to properly value the tax benefits of symbiotic structures. This challenge led Marshall and Quinton to collaborate with accounting innovators who were developing new frameworks for valuing previously uncounted forms of capital: natural, social, human, and cultural. These frameworks allowed organizations to better quantify the full range of value they created, making symbiotic structures more financially visible and comparable. The problem isn't just that we've been approaching tax efficiency wrong, Marshall explained in a widely shared article. It's that we've been defining efficiency too narrowly. True efficiency isn't just about minimizing a single cost. It's about optimizing the relationship between multiple variables. In natural systems, that might mean balancing energy expenditure against resilience. In economic systems, it means balancing financial costs against social and environmental returns. This broader definition of efficiency opened up new possibilities for tax planning. Rather than focusing exclusively on reducing tax payments, organizations could focus on maximizing the total value created per dollar of tax paid, an approach that often led to very different structural decisions. Organizations adopting this perspective began measuring their tax effectiveness ratio, the total value created, financial, social, and environmental, divided by their tax contribution. This ratio often revealed that strategies maximizing conventional tax efficiency actually reduced overall value creation relative to tax contribution. The most tax-effective organizations aren't necessarily those with the lowest tax rates, Quinton explained during a finance conference. They're the ones that generate the most value relative to their tax contributions. This often means paying a fair amount of tax but creating disproportionate value in the process. This insight led to the development of what Marshall and Quinton called tax leverage, the concept that taxes could be viewed not just as costs to be minimized but as investments to be leveraged. Organizations with high tax leverage used their tax contributions to enable value creation that far exceeded the amount paid in taxes. For example, a company might choose to locate in a jurisdiction with higher tax rates but better infrastructure, education, and healthcare systems, recognizing that these public goods enabled greater overall value creation than could be achieved by minimizing tax rates alone. This wasn't altruism, it was mathematical optimization considering all variables rather than just tax payments. The concept of tax leverage provided a new framework for thinking about tax planning, one that aligned profit motives with broader societal benefits. Organizations optimizing for tax leverage naturally structured themselves in ways that created positive externalities, as these contributed to their overall value creation without increasing their tax burden. But Marshall and Quinton's most controversial claim came from extending their analysis to the individual level. According to their research, the same principles that applied to organizational tax efficiency also applied to personal financial structures. Individuals could potentially achieve greater overall wealth by optimizing for value creation rather than tax minimization. The wealthy often employ complex, costly structures to minimize taxes, Marshall noted in a podcast interview. But our research suggests they might actually build more total wealth by focusing on optimizing their overall financial ecosystem rather than just reducing tax payments. This claim challenged conventional wealth management wisdom, which typically treated tax minimization as a primary goal. But the data supported their perspective. Individuals with moderately efficient tax strategies who focused on value creation often accumulated more wealth over time than those who made tax minimization their primary focus. The explanation lay in what economists call transaction costs. The resources expended to maintain complex tax avoidance structures often exceeded the taxes saved, especially when considering opportunity costs. Simpler structures aligned with tax system incentives typically required less maintenance and allowed greater focus on value creation. This insight led Marshall and Quinton to develop what they called the simplicity principle of tax efficiency. The most efficient tax structures were typically those that achieved reasonable tax outcomes with minimal complexity rather than minimal tax with maximal complexity. This principle explained a puzzling observation. Many of the world's wealthiest individuals paid relatively modest but non-trivial tax rates rather than employing the most aggressive avoidance strategies. They intuitively understood that optimizing for overall wealth creation rather than tax minimization alone typically produced better long-term results. Warren Buffett famously pays a lower tax rate than his secretary, Quinton observed in a lecture. But he's still paying hundreds of millions in taxes. He could reduce that further with more aggressive strategies, but he intuitively understands that the complexity would create friction that would reduce his overall wealth creation capacity. This observation led to their most provocative claim. Perhaps the ultimate tax efficiency wasn't about paying zero tax, but about achieving the optimal balance between tax contribution and value creation. A balance that might include substantial tax payments if they enabled disproportionate value creation. This claim directly challenged the title premise of their research, that there was a simple way to legally never pay tax again. Their conclusion was that while such strategies existed, they typically created more costs than benefits when all factors were considered. The truly optimal approach wasn't about eliminating tax payments, but about optimizing the relationship between tax contributions and value creation. The goal shouldn't be to pay zero tax, Marshall stated in the conclusion of their landmark paper. It should be to create maximum value relative to tax contribution. Sometimes that means structuring to reduce taxes, but often it means focusing on increasing value creation even if it means paying substantial taxes. This conclusion represented a fundamental shift in how tax efficiency could be understood. Not as minimization but as optimization. It suggested that the most efficient approach to taxation wasn't about finding loopholes but about aligning economic activity with the underlying purposes that tax systems were designed to serve. As their research continued to gain attention, Marshall and Quinton found themselves increasingly focused on practical applications. They developed tools and frameworks to help organizations implement symbiotic structures, emphasizing that the goal wasn't to eliminate tax, but to optimize the relationship between tax contributions and value creation. These frameworks proved particularly valuable for social enterprises, benefit corporations, and other organizations explicitly designed to create multiple forms of value. These organizations had often struggled with conventional tax planning approaches that failed to account for the full range of value they created. Symbiotic efficiency models gave them new ways to structure their activities for both impact and financial sustainability. But perhaps the most significant impact of Marshall and Quinton's work was how it reframed the conversation about tax policy itself. By highlighting the similarities between efficient natural systems and efficient economic structures, they suggested that tax systems might work best when designed to align with rather than fight against fundamental principles of efficiency. Nature doesn't tax photosynthesis, Quinton observed in a widely cited paper. It doesn't need to because photosynthesis naturally creates positive externalities. Similarly, human tax systems work best when they focus on addressing genuine externalities rather than trying to extract revenue from value creation itself. This perspective offered a potential path beyond the seemingly intractable debates about taxation that dominated political discourse. Rather than arguing about whether taxes should be higher or lower in general, it suggested focusing on aligning tax systems with fundamental principles of efficiency and value creation. The question shouldn't be how much to tax, Marshall suggested in testimony before a Senate committee. It should be what to tax and why. Tax systems work best when they tax activities that create negative externalities and avoid taxing those that create positive ones. This principle-based approach to tax policy found support across the political spectrum. Those concerned with economic efficiency appreciated its focus on minimizing friction in value creation. Those concerned with social justice appreciated its emphasis on addressing externalities and promoting regenerative activities. As their work continued to gain influence, Marshall and Quinton expanded their research to examine how these principles applied across different scales. From individual professionals to global corporations, from local economies to international trade systems. What they found was striking consistency. At every scale, structures that internalized externalities and created multiple forms of value simultaneously tended to achieve greater tax efficiency than those focused solely on financial extraction. This consistency across scales suggested they had identified something fundamental about how efficient systems operate, whether in nature or human economies. The principles of symbiotic efficiency weren't just clever tax planning strategies. They reflected deeper patterns of how complex systems optimize resource flows. In the final phase of their research, Marshall and Quinton developed what they called the regenerative efficiency model, a comprehensive framework for designing economic structures that naturally minimize tax burden by maximizing alignment with tax systems' underlying purposes. This model integrated insights from complexity science, ecological economics, and systems theory to provide practical guidance for implementing symbiotic structures across different contexts. It wasn't a one-size-fits-all solution, but a set of principles that could be adapted to specific circumstances. The model emphasized 5 key elements. 1. Purpose-driven structure. designing organizational forms around clear purpose beyond profit maximization, as purpose-aligned activities naturally qualified for more favorable tax treatment. 2. Stakeholder integration, creating governance mechanisms that integrated the interests of all stakeholders, as this naturally reduced expensive conflicts that increased costs and tax burden. 3. Circular resource flows, implementing regenerative resource cycles rather than linear extraction consumption waste patterns, as these qualified for numerous environmental tax incentives. 4. Community embeddedness, developing deep connections with local communities, as community-integrated activities typically qualified for various place-based tax benefits. 5. Transparent accountability, maintaining complete transparency in reporting all forms of value creation, as this maximized the ability to claim legitimate tax benefits while minimizing compliance costs. Organizations implementing this model typically achieved effective tax rates 30 to 50% lower than industry averages, not through aggressive avoidance but through natural alignment with tax system incentives. Moreover, they typically showed better long-term financial performance due to reduced conflicts, stronger stakeholder relationships, and greater resilience to disruptions. The surprising conclusion of our research, Marshall reflected in the final chapter of their book, is that the pursuit of tax efficiency, properly understood, can actually drive positive social and environmental outcomes. When we optimize for the relationship between tax and value creation rather than just minimizing tax alone, we naturally create structures that benefit all stakeholders. This conclusion offered something rare in discussions of taxation: a potential alignment between private and public interests. Rather than seeing tax efficiency and social benefit as opposed, it suggested they could be complementary when approached from a systems perspective. As Marshall and Quinton's work gained mainstream attention, it began influencing how organizations approach tax planning. Leading accounting and consulting firms developed symbiotic tax practices, helping clients implement structures that achieved tax efficiency through alignment rather than avoidance. These approaches proved particularly valuable during periods of tax reform, as organizations structured according to symbiotic principles typically required minimal adaptation when specific provisions changed. Their efficiency came from alignment with fundamental purposes that remained consistent even as specific rules evolved. This adaptability represented another parallel with natural systems, which typically show remarkable resilience to environmental changes. Just as the fundamental principles of efficient natural systems remain constant across varying conditions, the principles of symbiotic tax efficiency worked across different regulatory environments. The most impressive aspect of these structures, noted a partner at a leading accounting firm, is their stability. Traditional tax planning requires constant revision as regulations change. These symbiotic structures maintain their efficiency across regulatory shifts because they're aligned with the underlying purposes that drive tax policy rather than exploiting specific provisions. This stability created significant value for organizations, reducing the transaction costs associated with constantly updating complex avoidance structures. It also reduced audit risk, as activities genuinely aligned with tax system purposes typically attracted less enforcement scrutiny than those stretching the boundaries of compliance. As Marshall and Quinton's research continued to influence practice, they turned their attention to emerging technologies and their implications for tax efficiency. Blockchain, artificial intelligence, and the Internet of Things created new possibilities for implementing symbiotic structures at scale. Distributed ledger technologies enabled new ownership models that balanced individual and collective interests. AI systems made it possible to optimize complex value flows in real time. IoT networks allowed for precise measurement of previously unquantified forms of value creation. Together, these technologies created unprecedented opportunities for implementing symbiotic structures. We're entering an era where technology makes it possible to account for forms of value that were previously invisible to economic systems, Quinton observed in a forward-looking paper. This creates the potential for much more sophisticated alignment between value creation and tax systems. This technological evolution suggested the possibility of tax systems that dynamically adjusted based on actual outcomes rather than prescribed activities, taxing negative externalities as they occurred and rewarding positive ones in real time. Such systems would naturally favor symbiotic structures that created multiple forms of value simultaneously. Looking to the future, Marshall and Quinton anticipated a convergence between natural and economic systems, not just metaphorically but functionally. As economic systems increasingly incorporated principles of regeneration and symbiosis, they naturally aligned with the efficiency patterns observed in resilient natural systems. This convergence suggested the emergence of what they called natural economics, economic structures that followed the same fundamental principles of efficiency observed in mature ecosystems. Such structures would naturally minimize waste, including the waste associated with excessive taxation and compliance costs. The future of tax efficiency, Marshall concluded in their final joint paper, isn't about clever schemes to avoid contribution. It's about redesigning economic activity to create so much value that the necessary tax contribution becomes proportionally small relative to the total value created. This perspective offered a profound reframing of how we think about taxation and efficiency. Rather than seeing taxes as costs to be minimized, it suggested viewing them as indicators of how well economic structures were aligned with societal needs. Low effective tax rates achieved through alignment rather than avoidance became markers of truly efficient economic design. In this view, the path to minimal taxation wasn't through aggressive avoidance but through maximal contribution, creating so much value across multiple dimensions that the necessary tax contribution represented a small proportion of the total value created. This conclusion might seem counterintuitive, even paradoxical. How could creating more value lead to lower tax rates? The answer lay in understanding tax systems' fundamental purpose, addressing externalities and providing public goods. Economic structures that internalized externalities and directly created public goods naturally attracted less taxation because they required less external correction. The ultimate tax efficiency, Quinton reflected, comes not from fighting the system but from embodying its purpose so completely that formal taxation becomes largely unnecessary. This insight brought their research full circle, back to the natural systems that inspired it. In mature ecosystems, each organism's self-interest is aligned with the health of the whole system. No external taxation is needed because the system naturally optimizes resource flows for collective benefit. Similarly, the most efficient economic structures align individual and collective interests so completely that formal taxation represents a small adjustment rather than a major redistribution. The tax burden is naturally minimal because the structure itself addresses the issues that taxation is designed to correct. As we reflect on Marshall and Quinton's remarkable journey from theoretical physics to practical tax strategy, one insight stands out above all others. The most fundamental laws of nature and the most practical aspects of human affairs follow the same basic principles of efficiency. By understanding these principles, we can design economic systems that work with rather than against natural patterns of resource optimization. The question that began this exploration, whether there is a simple way to legally never pay tax again, turns out to have a nuanced answer. While complete tax elimination through avoidance strategies is possible, it typically creates more costs than benefits when all factors are considered. The truly optimal approach isn't elimination but alignment, creating economic structures so perfectly attuned to tax systems' underlying purposes that tax efficiency emerges naturally. In the end, the science of tax efficiency reveals something profound about all efficient systems. They don't waste energy fighting fundamental forces, but adapt to work with them. Just as water flows around obstacles rather than trying to move them, truly efficient economic structures don't fight against societal needs but align with them. The resulting tax efficiency isn't an exploitation of loopholes, but an expression of fundamental harmony between individual and collective interests. Perhaps the greatest insight from this exploration is that nature has already solved the problems we struggle with in human systems. The patterns of efficiency observed in resilient ecosystems offer blueprints for designing economic structures that naturally minimize friction, including the friction of excessive taxation. By studying these patterns, we can create systems that achieve tax efficiency not through cleverness but through fundamental alignment with how efficient systems naturally function. In a world of increasing complexity and interdependence, this alignment-based approach to efficiency offers something beyond mere tax savings. It offers a path to economic structures that create abundance for all stakeholders while naturally minimizing waste. And in that sense, the pursuit of tax efficiency, properly understood, becomes not just a financial strategy but a pathway to more sustainable and generative economic systems. The true simplicity on the other side of tax complexity isn't zero taxation through clever avoidance but optimal taxation through perfect alignment. An approach that follows nature's fundamental principle that the most efficient path is always the one that creates the most value with the least waste.